the experiences division or the theme parks division, as you just pointed out, makes up less than 40% of total company revenue, but almost 60% of profit. So really, it is the crown jewel, as you rightly alluded to it. And, again, the profit there was really strong. And I think coming in, investor expectations were really, really low. Profits were up 20%. Remember, consensus was at about 10.5% increase. So again, really strong numbers. And what it really did was allayed fears, because Comcast, which just reported a few weeks ago, talked about weakness and a demand slowdown in their Universal theme parks, especially in Orlando. And now seeing Disney come out with such strong numbers really shows that they're executing really well, and demand continues to be strong as they head into the fiscal fourth quarter as well. But then, as you again said, streaming, which is part of that entertainment division, is really the growth catalyst for this company. And it's all about streaming profitability and how far ahead they can get on operating margin for the streaming business. And they proved that they did a really good job this quarter. And there's obviously a lot more growth levers going forward.
Geetha, this is the second straight quarter of better than expected profitability for the CEO, Josh D'Amaro, who succeeded Bob Iger in that role in March. Talk about big shoes to fill. What's the early read from investors on Mr. D'Amaro?
I think they're really liking all what they see. Josh obviously has a very clear strategy. He's made some pretty big changes. So just today, for instance, they announced that they got rid of their 50% stake in A&E Global Media. They got about $1.2 billion in cash, and they're going to deploy that towards share repurchases. Then again, you have this a new deal. They had to get out of their Sora deal after obviously Sora shut down. But now they announced this new deal with TikTok. So again, Josh is, I think, really kind of taking a hard look at all of the different businesses. He obviously knows that they need to reduce their exposure to, linear TV. But they're doing all that they can in terms of streaming, and of course, he's a parks veteran, so he knows exactly, how that business works. But it also looks like he's positioning Disney Plus to become this major hub for the entire Disney ecosystem, something almost akin to Amazon Prime for all things Disney, starting in spring of 2027. And so I think that's going to be pretty exciting for the company.
Yeah, that sounds very strategic. How do you think about how that's going to change the entertainment industry and how other media companies respond to that kind of positioning?
Yeah, so I mean, Disney has a really unique hand to play here, Scarlett. I mean, they have theme parks, which really, other than Comcast, nobody else has. Obviously, they have this great movie and studio business, and of course, that their streaming business too. And the one thing that they have, or they do better than everybody else, is ESPN and sports. They have huge exposure there to all of the marquee sports rights. So, again, it's all come down to one thing in the streaming world, which is engagement. And if they can build on that engagement and keep you within that Disney ecosystem for everything. I mean, whether you're buying a theme park ticket or wanting to watch a movie or wanting to watch a show on Disney Plus or Hulu, right there, that's a major differentiator versus their peers.
So, Geetha, Paramount also reported numbers here. I'd love to get a sense of kind of what the company's saying these days about their, I guess, stalled merger with Warner Brothers Discovery and how they plan to operate as a single entity over the next 12 months.
So their numbers yesterday, Paul, were actually pretty decent, and a lot of that was just the cost savings from the Skydance, acquisition. So it's pretty clear that once they are able to get their hands on Warner Brothers and they're able to close on that transaction, they're obviously going to do all that they can to, deliver on those $6 billion in synergies. But it's really been a very long and arduous road, and it's not looking, easy at all. So one of the things that I think people still are extremely concerned about is leverage. We know it's going to be about 6.5 times at closing whenever that happens. And then the other thing that you have now is kind of this ticking fee, right? And so that's because this deal is going to get delayed by at least 2 full quarters. It was supposed to close on September 30th. It's going to be maybe closer to end of March timeframe. We're going to see close to almost about $1.3 billion in ticking fees. And guess how that's going to be funded? more share issuance. So we're looking at massive dilution here. I mean, Paramount Skydance share, a number of shares outstanding right now is 1 billion. It's going to go to close to about 5 billion when all of this is said and done. So this is just, it just is not a very, very encouraging outlook at all from an investment perspective.